Hello and welcome to the Real Talk Office Hours Hunting for Silver Linings for this Monday, August 10, 2020. Hosted today by George Katsanos and our very special guest, we have Jason from Boston joining us, Chapter Director for Startup Grind over there. We are brought to you by Startup Grind, the world's largest startup community. We have 600 plus chapters in over 125 countries, and we operate with a mission to educate, inspire, and connect. And we are also driven by three distinct values. That's make friends, not contacts, help others before you help yourself, and give before you take. The pandemic has been and will continue to be the great global leveler. And as entrepreneurs, we need to do our very best for our businesses, our teams, and families. And we need to do so by being informed, rational, analytical, and rigorous in our thinking. We should also learn to control our biases as they emerge in various circumstances. We do invite everyone to join us every Monday, Wednesday, and Friday as we track these intersections of the facts, biases, and action through our review of global financial markets, alongside the check-ins with Real Talk with the Startup Grind chapter directors, entrepreneurs, and ecosystem stakeholders from around the world. And we do this because no one has a crystal ball, but if we keep our eyes and ears open and pay attention, we may be able to see around the bend, and with some luck, spot the silver linings that are around every cloud. If you miss the live events, you can always view the recordings at startupgrind.com/grand-rapids. And before George gets into the global market update, just a little bit of housekeeping. Comments made and views expressed by all participants in this podcast are not intended to invite or incite individuals, entrepreneurs, or investors to buy or sell financial assets, real assets, commodities, futures, and or options. The purpose of this podcast is to educate and to inform, not to trade or to invest. If you feel compelled to trade and or invest, please call your broker. Remember, however, risk is everywhere, even when you think that you're not taking the risk. And with that, it's my pleasure to let George get started with the catch up on what the global markets are doing.
Hello, gentlemen. Jason, welcome. Scott, welcome. This is Real Talk, the way we present our case to the world every Monday, Wednesday, Friday is very simple. We try to depoliticize the debate by focusing initially on a review of the financial markets. What we always mention to our investors, to our entrepreneurs who are part of the ecosystem, is that the world doesn't consist only of of equities. The world consists of currencies, commodities, interest rates, fixed income, and of course, a whole range of other asset classes. Each one of these asset classes convey information that are important to the participants. And for the startup world, this information is relevant insofar as assessing the risk. The healthcare pandemic is one type of risk that, as you are well aware, Bill Gates alerted us to back in 2015. This is the beginning of a series of pandemics going forward because of the nature of the environment. Unless we take some serious action to redefine who we are, as Jared Diamond said, the ruling elites are making decisions about whether to survive or to die. So against this background, let me start by looking very quickly into the currencies. What we normally do is we go through the major crosses, namely, just give me one moment to share the screen. There we go. The cross-currency rates, particularly dollar-euro, dollar-yen, dollar-sterling, dollar-Aussie, dollar-Canadian, and dollar-Swiss, are indicative of trends in investors' both sentiment but also risk appetite. As we mentioned at the beginning of our series, back in late March of 2020, the dollar stood at 105, 106 against the euro. It traded as high as 119 and change a couple of days ago. Now it is hovering around 117.80, 118. The weakness of the dollar was premeditated to some extent, simply because the flooding of the economy by dollars affected people's perception about the value of the currency. In that sense, we've seen sterling strengthen tremendously, the yen strengthened equally dramatically, the Aussie dollar and the Canadian have all strengthened, as indeed the Swiss franc against the dollar. This represents what we call the risk-on factor. Investors are left the safe haven of the dollar where they came in the middle of the crisis, and they're now returning to other opportunities and investment opportunities, in particular, around the globe. The story of interest rates, however, is more nuanced because the fixed income investors, the investors in bonds, tend to be more conservative. They care not only about the return on their investment, they care for the return of their investment. And this is why the strong, very strong 10-year bonds suggest to us that fixed income investors are still concerned about the global economic environment. And that's why the 10-year yield in Japan is 0, as anchored by the Bank of Japan. The Australian is stuck at 0.86. We mentioned before that both Japan and Australia explicitly have what we call yield control policies, meaning they target specific yields to their bonds so that they can issue bonds without too much expense. And that is relevant for us. There were some articles a couple of weeks ago suggesting that the Federal Reserve might be pursuing similar policies, but we haven't heard that officially, at least. South Korea and India are the high yielders, or among the high yielders in relative terms, in the 10-year bond space in Asia. India is anchored at 5.8, South Korea at 1.4. On the European front, we have seen massive rallying in the fixed income instruments, the 10-year bonds in particular, over the last few weeks. Germany at minus 0.5%, Switzerland at minus 0.6%, and at the other end of the spectrum, the high yielders, Italy and Greece, hovering at about 1%. These are dramatic 10-year yields in Europe, and they suggest that not all is well in the Kingdom of Denmark, as Shakespeare said. We will see how the recovery in Europe takes shape, if at all. In the Americas, the 10-year bonds are also benign. The movements are minuscule. The US is trading under 0.6%, the 10-year bond. Mexico 5.7, Brazil 6.8%, and Canada at about 0.5%. Again, historically low yields. If the tit for tat between China and the US worsens, and if Congress remains deadlocked and the executive orders remain in order, as many observers, as many analysts have indicated, they are stopgap. That means that the recovery could falter. Despite some positive numbers that we saw last week about jobless claims and the unemployment falling to 10.2%, we remain skeptical, and we advise our investors and our entrepreneurs to be careful short-term and medium-term. This pandemic is not going to be a short-term event. Looking at the commodities world, on the other hand, we first look at energies because they have been the most dramatic. You may recall that we saw at the end of March, oil trade at minus $37. Now it's trading at plus $42. That's West Texas Intermediate. Brent in Europe is trading at $45. Again, big changes. Two things are happening. One, the supply is slowly eaten up. B, the world demand seems to be slightly rising. Again, the summer is still on in the Northern Hemisphere. We still have traveling, especially here in the US. We will see what happens in September. And the natural gas, because of the hot weather, is at 2.2. These are significant numbers, at least historically. Gold, on the other hand, continues its rally. My goodness, it's up $30 today. It's 2055. We've seen it as high as $2061. That is an indication that the demand for gold is predicated on two things. One, the debasement of global currencies because of all central banks' issuance of money, and B, safe haven considerations. So in a sense, the gold investors have a very conservative outlook, indeed similar to those of the fixed income investors. Silver is near $30. Amazing rally in silver. I cannot comment on this except that silver is an industrial good. as indeed is copper. And we see that copper is rallying significantly as well. On the agricultural front, the pessimism in the market remains. Corn, wheat, soybeans across the board are underperforming. And the reason is the buying from China is not there except sporadically to meet the part of the agreement with the United States. As you have noted, the weather in the northern part of the United States has been tremendously good. Rainfall has been consistent and the crop is very large. So we would expect that prices to remain under pressure, which brings us to essentially the stock market. As you can see from our table here, with the exception of the Hang Seng, which was down 0.6, the rest of Asia is either small changes or green, very green. And the same thing in Europe. This is trend that we've seen all the way from the 23rd of May. The central banks have done well. The fixed income investors have been conservative, but the equities investors suffer from two major faults. One is TINA, there is no alternative. And the sector is called FOMO, the fear of missing out. So in a herd mentality, they have piled in and they have bought the equities. Some people suggest that with a 10-year at under 0.6%, there is more for the equities to run. Again, the valuations are stretched by historical standards, but who are we to judge the market? The Federal Reserve is running the economy. The Federal Reserve is running the markets. And let me now stop the review of the financial markets and introduce our participants. Scott Carroll, Jason Kraus, welcome to Real Talk.
Thank you. Yeah, it's great to be here. And no, thanks for the rundown. And yeah, that was a great analysis.
I hope you can hear well. What I will do is, for the benefit of bandwidth, I will reduce my video, but I'll stay online. Jason, would you like to give us a little bit of, about your background? Talk to us a little bit of how you joined Startup Grind and how did you get interested?
Sure. Sorry about that. Yeah, definitely. So, it's great to. Sorry, my dog's barking. Yeah, I mean, it's great to be back
to
on
the interview.
Yeah. No, it's great to be on here. Yeah, basically my background is in the venture capital space, and yeah, so I had worked in a family office as a deal flow analyst, and then I've also been a part of the angel investment group, and now we have like more of a micro VC model. Sorry, let me. Oh, there we go. Okay, should be good now. Yeah, basically, so yeah, background in the venture capital space. Worked on early stage seed to Series A deals, mostly across technology and healthcare. Also started sort of on the other side, a consulting and advisory company called Prepare for VC, where I wanted to take what I learned on the investment side, brought in some other investors and entrepreneurs that have been through the fundraising process themselves as well, and help startups we work with go through the full fundraising process. So we help them build out pitch decks, business plans, learn how to pitch to investors, and how to sell what they're doing as an opportunity to investors. Yeah, and all of that, just working with startups, investors, the whole community, like wanted to get more involved, or had gone to a lot of great meetups and events in Boston, even some of the Startup Grind ones. There's a previous group before I took over, and really loved what Startup Grind was doing, the whole mission of sharing first, like giving back to the community first before you really ask, or, the more you give out, the more everyone helps each other in return. And then, had the opportunity to get involved and take over as the director of our chapter. And yeah, I've had some great speakers in, and yeah, excited about everything. Like, met a lot of great people so far just from our community and events, and excited to connect with other chapters like yours.
Thank you. Thank you. That's a wonderful background. It is quite unusual to have a venture capitalist be a leader of a startup grind. Normally we have entrepreneurs, and I'm sure you bring a different perspective. Can you tell us a little bit about your ecosystem? What are the main sectors, for instance, that are represented in terms of both investee companies, but also the sources of capital?
Right. Okay. Yeah, basically, so Boston, or we have some deals outside of Boston as well, but I mean, it's the majority of our deal flow comes from the local area. So, the strongest suit or the strongest sectors locally are the healthcare, biotech space. A lot of hospitals and university research that funnels into those channels, as well as traditional like technology companies. So financial technology, more B2B and SaaS, and then some consumer facing companies like DraftKings and TripAdvisor both came out of Boston. So yeah, there's more, pretty much technology, and then biotech and healthcare are the main ones. Not as much, or there are some strong like consumer goods companies, but not as more of the focus has been on the other two sides there as well. And then there's a good number of angel groups, probably 10 pretty strong ones around like the Boston to Rhode Island, or like, yeah, Boston to Providence area here. And there are some, yeah, there's a good number of angel groups, several VC firms, mostly focused in those sectors as well. Some, on the, like, we're not too far, or we're 3.5 hour, or depending on traffic, 3.5 to 4 hours from New York too. Which, I mean, that has they seem to have like pretty strong investment scene in more of the like consumer products and some other sectors that we shift back and forth. Like they'll invest in more of the biotech startups in Boston. We might invest in some of their other industries where there's a stronger focus there as well. But yeah, I'd say, the biggest, we have an event coming up with Brad Feld, who is one of the Techstars founders, and has this group, or the Foundry Group. And yeah, so in his new book, he was talking about how there's different sources of capital as well. I mean, there's the financial capital, but also like the human capital, the knowledge that you're bringing in, and other and even within the financial capital space, there's traditional equity investment, there's more debt financing. There's a couple groups trying to, or relatively early on, but bringing more like revenue-based financing and other approaches that might help different types of startups out. So, I mean, I see the communities pretty growing, like pretty strong overall, and yeah, it's always like shifting in the way we work with companies, and great to see, even through the pandemic, it seems like everyone's coming together even more to to figure out how they can get involved in the startup communities and help each other out to come out stronger.
Thank you, Jason. One of the last items that we always ask our directors to inform us about is the infrastructure of the ecosystem. You have talked about how well developed the system is in terms of both the sectors of the startups, but also the sources of capital. Where does creativity, where does innovation come from? Does it come from the centers of academic excellence that you have? Does it come from the existing entrepreneurs who are serial entrepreneurs? Does it come from outsiders who bring ideas because Boston is such a fertile system? Can you talk a little bit about the infrastructure?
Sure. Yeah, I'd say it's a combination of all of those. So on the serial entrepreneur side, so the angel group I've been most involved with, Boston Harbor Angels, that it's been around 15 years now, and we're starting to see like some of the successful entrepreneurs that have had exits in the past. There's some companies that had IPOs like Carbonite and Corbus Pharmaceuticals, and a few others that the founders and management team from those firms are coming back to the group on their next venture. Having had success in the past, it's relatively easy to fundraise from investors you've already shown success with, and then they sort of are the leaders of. Some of them start new companies from scratch, and I've seen some also like join in more of a CEO or leadership role at existing startups they vet out and join on to help them go through the scale up process. But also, there are a lot of great companies starting out of the universities here, and then even on the tech side, I'd say a lot of them just they start out in those schools, build a team, or find talent and resources from that community. On the healthcare side, like there's usually they'll start in one of the labs at one of the schools and sort of spin out at like find more of an entrepreneurial, or they'll have like great research labs and teams involved, and sometimes those teams will still act as a co-founder or partner on the business, but then they'll find more of like business and entrepreneurial leadership team to come in and sort of spin it out as its own startup and bring it to through the whole fundraising and FDA approval process. And then, still a lot of great innovations that are coming out of just people that are a little bit later on in their career and, have done or sort of have a vision that they think would work well, but maybe like the corporate structure and leadership in their company sort of doesn't move as quick as the startups scene, so they go out and start something on their own, given all the knowledge and expertise they've had from years in whatever industry they've been working in.
Thank you. That's great analysis, and is a good segue to my question about the trends in the startup world in your ecosystem. You're obviously you must be seeing trends either in terms of pivoting or changing operations, or perhaps when we look at a company broadly, we look at products, people, and processes. And COVID must have influenced all these three aspects. So if you could spend a little bit of time to tell us, what do you see are the main trends with startups in your ecosystem?
Right. Yeah, I think obviously there's a lot of businesses right now that were hurt by the pandemic, either not being able to have retail locations open, or just, service businesses, a lot of industries that are, pretty hard to replicate virtually. And it's been sort of a time for, companies within those sectors that might have been resistant to technology in the past are sort of forced into it right now. And I think it's a good time and trend for companies that either enable those types of businesses to stay up and running or enable more remote work. Yeah, there's a lot of like trend and focus in those areas right now. Also, like there's certain, we've had a couple chats about this as well. There's always like hot trending topics in technology that it started out. So if you look 10 years ago or so, there were specific companies called like, or there were specific cloud technology companies. Now it's just most companies are running on some sort of cloud infrastructure, and it's sort of assumed that, or you're not necessarily a SaaS company, you're just whatever, you're a fintech platform that happens to run on, use that type of business model. And I see sort of the same thing starting to happen in more of like AI and blockchain. There'll be a lot more startups that in the long term aren't considered AI startups. They're just maybe a solution for the restaurant industry that happens to use AI as one of their technology platforms. Yeah, and some other examples like that as well.
Do you have any unicorns in the recent past? Any outstanding successes?
Yeah, so there's one of the big ones that's in the news right now. I don't know when they exited, but Moderna is a Boston-based former startup, now
Quite an
public
impressive
company.
history.
What?
Impressive. The history of Moderna is quite impressive.
Yeah, and they're one of the leaders in the race for the vaccine right now. We've had like DraftKings, TripAdvisor, Draper Technology, a lot of, and then Carbonite Data Storage Company. There's been a lot of, bigger startups coming out of Boston or turned corporate. We can claim Facebook started at Harvard as well, even though it's more of a San Francisco, Silicon Valley company now. But yeah, I'd say overall, there's also more of a trend here, I think, versus, or there's more of a trend in a lot of companies that can have sort of a level of success with less funding. So, investors here might be looking for a company that might only need up to $5 million in investment in their lifetime and could exit as a $100 million, $200 million company versus some other cities. More of the focus is on like how much money can we put in now and scale this to either be a unicorn company or fail, but like let's aim for the unicorn. So I think there's a lot more smaller successes here, and that's more of a lot of the focus for some of the early stage investors as well.
Your last comment is quite interesting and brings me to ask you, what happened to valuations? Where were the valuations pre-COVID, and what do you see in valuation trends at the moment?
Yeah, I think it depends on the startup and their situation. So, the ones that still had, I've talked with some companies that closed, they closed rounds in February and had great timing on that, earlier this year. And any company with a pretty good cash runway, still valuation wise isn't as affected through this, but there's a lot of startups that were anticipating to raise capital. Now it's been, between March and August already here. So anyone that was sort of anticipating fundraising in that time or had to raise a round might have either had to lower some of the valuation expectations, or especially at the beginning, I think it's picked up back up. The investment scenes picked back up a little bit, July and August, but or at least through March through May was pretty slow there. So companies were offering either lower valuations, or giving warrants and other incentives to investors to come in now, rather than wait and see how more of the mindset was like, let's wait and see how long this lasts and then invest in these companies. But yeah, there are different incentives startup founders were giving to people, like, to get in now versus more of a wait and see model.
Thank you. That's a great summary of what is happening in Boston. And may I turn to Scott for a moment and ask Scott, since he also comes from the entrepreneurial side of the business, Scott, what would you describe as the next normal?
Repeat the question.
Yes, one of the questions we ask our directors from all over the world is, what is the next normal like, if there is such a thing as a next normal?
From the startup side?
Yes.
Well, what I'm hearing and experiencing on my side is less. It seems to be heading away from consumer-driven, product-driven. How do we scale fast and large, to how do we scale for quality? The conversations that I'm hearing are, yeah, it's there's been a lot of questioning going on about how this process works over the last 6 months. And, we hear, as you start a new company, there's an 87% failure rate for software and for startups, and et cetera, et cetera, et cetera. And of course, before this all started, a lot of VCs were hemorrhaging money. And I think there's been a come to Jesus moment. At least this is what I'm hearing globally, where a lot of VCs and even the incubators themselves are saying, okay, is there a better way to do this process? Does it mean slowing the process down a little bit, scaling at incremental stages instead of trying to go out and unicorn it all at once? I know in my research, the companies that tend to do better are the ones that take 3 to 5 years to develop. I'm not seeing.
So you're going back, in a sense, to the origin of the business of venture capital. Instead of accelerating at dramatic pace a natural business cycle, we saw in the notes a tremendous acceleration from zero to hero. Now we're going back to a more paced approach. Is that correct?
No, absolutely. And the conversations that I've had with some of my cohorts are, business school 101 is you don't build 1,000 Starbucks franchises in a year. It's a good way to implode your company. And those rules haven't seemed to have applied into the startup space, particularly in tech. And my sense of it is because there's a lot of money, there's a lot of hopes of becoming the next Facebook, and because the numbers aren't real. If you have to build 1,000 Starbucks franchises, there's real concrete, there's real buildings and plumbing and fixtures and stuff that are going in. And there's an arduousness to it that is lacking in the software space. And I think there's a sense of, there's a disconnect from reality. But we studied,
it's interesting.
I
was going to say, you're echoing a little bit what our Jakarta-based interlocutor said on Friday, Jessica, that they're taking a step back and waiting till the dust settles, and then they will start looking into opportunities again.
Yeah, I think that some of the early software kings have talked in the last couple of years, some of the legends of the business have talked about how, the model was set up to sell people's data, et cetera, because we didn't know anything better to do. We didn't know how to do that. And I know when we started our process 2.5 years ago, we looked at this all very carefully and said, there is a better way. And one of our first 3 tenets before Cambridge Analytica was to say, we're not going to sell your data. And we built our product accordingly. And my research, looking at the companies who I respect in the space, they have spent a lot of time really understanding in almost an IDO way the behavioral characteristics of their users, what people are really going to respond to, and what value is. The other thing that I've noticed, again, this is just observational on my part, is a lot of startup founders start with great intentions, and then the money comes to the table. And I've seen a lot, people watch things like Shark Tank, and I've sat through pitch meetings where investors act like it's an episode of Shark Tank, and they want scaling and they want it fast, and they sort of hijack the mission of the company and the good ideas. This isn't unusual. We see this in the film industry all the time. Somebody loves your script and then they fire you and hire somebody else to rewrite it. This is, it's people wanting to put their thumbprint on it.
Oh, sure. I mean, that's why the VCs get seats on the board of directors, and within 6 months of investment, they change the CEO and the CFO, and they put their own people there, right?
Yeah, no, exactly. I was in a conversation 2 years ago with a VC regionally who had made a bunch of money, and I talked a little bit about my idea, and he pontificated about how there's an 87% failure rate, and I said, And then partway through, he corrected me and said, this isn't how you do it this way. This is how everybody does it. That was a direct quote. And I looked at it and I said, these are the same people who fail 87% of the time. And I think what COVID has done is it's forced people to step back and say, maybe we haven't been doing this the right way. And maybe there's another way to create value in a company and in a product without running out the door and trying to hit your first 1 million users in a week.
Right. No, I think that's a lot of great points there. And I mean, one side, too, is a lot of the valuations are built around sort of the growth model, but people also have to realize, and I think this is coming to more of the forefront now, that, the more profit you build in, the less you have to fundraise and worry about, are you going to have to raise more capital during a pandemic? So, if you can build some level of profitability into the business and still focus on that growing fast enough to be, an attractive company to new investors, to acquisition, or whatever your goal of the company is, I think there's a balance you can build and still have some level of security in the company itself.
I agree. I think the mindset seems to be shifting away from hyper growth. There seems to be a more measured approach. I'm hearing this both from the building side, the operator side, but also from the VC end. There's been a major sort of upsurge in the term social impact investing. There's a huge network coming out of Western Massachusetts. It's global. It's got 25,000 members around the world right now. And this is and it's from policy to government leaders to VCs to creators, looking at how do we build a smart product that's actually going to make a difference and is scalable. And this is something I kind of stumbled upon. This is where we started when we started down this road a couple of years ago. So yeah, I think it's given everybody a chance to kind of hit the pause button a little bit and say, okay, knowing what we know now, how would we do it differently? And what would that look like? And
Thank you. Thank you. I mean, these are tremendous insights that you are both are raising, and we have not heard them from any other member of the community so far. ESG on the one hand, valuations on the other hand, questioning the old acceleration model, the third issue. I mean, these are big questions.
I believe, and I have always, I've had other startups in other spaces, and I've always believed that you can actually do good things and make a lot of money doing it simultaneously. But you have to there's a lot of development time, and there's a lot of, you know, in-depth dive. And you talked earlier on about sort of this multidiscipline approach to things, and I refer to it as the IDL model. And this is how we've approached it. We have filmmakers and scientists and architects and physicists and software developers. And, you know, we haven't let the company be hijacked from the technology side. We focus purely on the customer experience side, and we've built back with our technology and our understanding and created some new things along the way. Because I've always believed, and certainly as a filmmaker, you know, if your audience doesn't want to watch your film, then you've wasted your time. So we start with that moment, and then we back up to where we are and say, okay, how do we achieve that? So we've got people on board who are CGI folks from Lord of the Rings, who are helping us develop the filters and give it as realistic an experience as humanly possible. So
thank you. Thanks, Scott.
Yeah.
As we're wrapping up this interview, there's one question I would like to ask you too, and you give me your answer. If there was one advice that you would give to startup entrepreneurs, what would that be?
Is this to me?
Scott, it's both to you and to Jason, and you
Okay.
can take turn. But think of the fact that we have a global community, and other directors will listen to the interview after we have put it up in the web. What is one advice that you would give to young entrepreneurs?
Sure. Yeah, happy to start here. I'd say, you know, go out and start talking, start talking to people and testing your idea early on. A lot of companies are still like, want to make sure, you know, every detail, every feature is built out and every aspect of the business is in place. And then you might end up realizing, you know, a lot of the great companies really have one feature that everybody loves. So like Instagram, people love photo sharing. You know, Facebook, they like, you know, connecting with their friends. Even, you know, the healthcare companies, a lot of them have a bunch of different applications they could go after, but they go after one target. Their drug can really, or the molecules and drugs they found can make the biggest impact with. So I think like do some more, or do, you know, enough customer research that there's an opportunity, but also like get out there and talk with the right people early on to figure out how you want to shape it, instead of just trying to visualize everything in your head.
Thank you. Thank you. This is part of essentially the idea that it takes a village to raise a child.
Right.
Scott, you
Yeah,
please.
I'd say there are three things. Educate, educate, educate. Talk to as many people as you can. Look for the patterns and don't assume. Question everything. Don't just assume conventional wisdom is correct, because it might have been correct 6 months ago. It may not be correct 3 months from now. So look for patterns and then think it through carefully. And then, as Jason said, then you take it to, you know, to early stage testing and put it in front of people and see what their response is. But I think that's the best way to get around confirmational bias and get out of your headspace.
Thank you, Scott.
Sure.
Thank you, Jason. The idea of groupthink is deeply ingrained in our society, and we all know that the best way to get out of the confirmation biases, the groupthink biases, the status quo biases, is essentially to start questioning your assumptions. As Corey and I always said at the wrap-up of our conversations with all our directors, please feel free to ask Corey and myself for any help. We have built companies ourselves. We have coached executives, managers, and we're always there to give ideas and support. Thank you for joining us today.
Thank you.
Thank you. Yeah, this was great.
Thank you. Bye-bye.
Okay.